Well, there is a solution, but politically, it's not on.
It's
the solution basically is to really slash public spending and put the dollar back on a gold standard.
Yeah.
But you've got problems there. I mean, the idea that you can get on a gold standard. First of all, nobody believes that they've actually got the gold. They would have to prove that. And governments are not in the business of telling the truth in these matters. So they've got to and furthermore, Craig, there is nobody in government who actually understands the relationship between gold and currency.
Yeah,
they all think the dollar is actually money. It's not.
Yeah.
They don't understand this.
The dollar's collapse may be closer than we think. Alasdair MacLeod, a monetary analyst, highlights that the US dollar has lost nearly 99% of its purchasing power since departing from the gold standard. He traces this decline back to the early 20th century, noting that the dollar remained tied to gold at $20.67 per ounce until 1934, with the Gold Act of 1900 formalizing the standard. Over time, the disconnect from gold has left the currency increasingly vulnerable to inflation and devaluation, undermining its long-term reliability as a store of value. MacLeod warns that the Federal Reserve has little real control over the current crisis, which is largely driven by political forces and entrenched voter expectations. He argues that meaningful solutions only arise after a crisis occurs, but extreme monetary and economic breakdowns, such as Germany's experience from 1920 to 1923, can produce unpredictable and potentially dangerous political consequences. According to MacLeod, the only true solution to the dollar's ongoing decline would be drastic, cutting public spending and returning the currency to a gold standard. However, he stresses that this is politically impossible. Governments rarely disclose their gold holdings and lack a deep understanding of the fundamental relationship between gold, currency, and credit. Even highly educated officials at the Fed and Treasury would need to relearn basic monetary principles, making a gold-backed solution virtually unattainable under current conditions. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
Well, basically, what you've said it all. I mean, the purchasing power of the dollar has is fallen 99%. Those are the numbers you're saying. 99% since the dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce, and that was from, 1856 or something. And it was, it was de facto, but then it became de jure with the Gold Act in 1900. Basically, when the Fed came along, they screwed everything up because under Benjamin Strong, they expanded credit. I mean, Benjamin Strong was a great believer in stimulating the economy with extra credit. And that led to the Roaring Twenties, which led to the collapse between 1929 and 1932, enhanced, I may say, by not President Trump, President Hoover's tariffs at that time, which was the Smoot-Hawley Tariff Act of 1930.
Yep.
And President Trump is doing exactly the same at the top of the debt-cum-credit bubble, which makes 1929 look like a pimple. I mean, this is the big one. It really is. And it'll destroy the currency. I think it's so important. We've got to understand this, and we've got to be prepared for it. Yeah, I mean, basically, no. We used to have a phrase, which I don't hear nowadays, about kicking a can down the road. People, I think, sort of think, whoops, I don't think it's, they start talking about a reset and, all this sort of rubbish. I mean, the fact of the matter is that the Fed has got no control over the situation. And it can't have control over the situation because the situation is politically driven. And until you persuade an electorate, to give up all their welfare this and welfare that, and, all the pressure groups to, that, look, you're out of here, forget it. We're actually going to deal with this one seriously. Until that happens, no. I mean, there is absolutely no solution, Craig. And, I've always said it's crisis first, solution second. I mean, once you have the crisis, then you can start talking about a solution. But is that really going to work? Well, I'd like to think so. But the fact of the matter is that when you get those extreme economic and monetary conditions, like, the credit collapsing in terms of its value, all bets are off. This is what they found in Germany, because what happened in 1920 to 23 led to Hitler, led to the Second World War.
Right.
Hayek actually put this very, very well in his Road to Serfdom. He sort of had a bit where everybody starts saying, we need a strong leader, to get us out of this mess, because they'd had enough of the weak politicians who screwed it up. We need a strong leader. And what do they get? They got Hitler.
Mm-hmm.
What are we going to get?
That's the concern for sure. It's like
Trump could well be a sort of fairly moderate individual by comparison. Well, there is a solution, but politically, it's not on. The solution basically is to really slash public spending and put the dollar back on a gold standard.
Yeah.
But you've got problems there. The idea that you can get on a gold standard. First of all, nobody believes that they've actually got the gold. They would have to prove that. And governments are not in the business of telling the truth in these matters. So they've got to get that hurdle. And furthermore, Craig, there is nobody in government who actually understands the relationship between gold and currency.
Yeah,
they all think the dollar is actually money. It's not. Yeah. They don't understand this. They have got to relearn economics. They've got to relearn what money is and what credit is. So you've got all these PhDs sitting in the Fed and presumably also in the US Treasury. They've got to go on a re-education course. How long is it going to take them to understand that?
Right. Yeah,
this is not going to happen. It's not going to happen. Yeah. Believe you me.
Alasdair MacLeod explains that current economic trends show striking parallels to Germany's experience between 1918 and 1923. Following World War I, the Reichsmark's purchasing power first collapsed by roughly 80% between 1918 and 1920, then briefly strengthened from 1920 to 1921 before ultimately plummeting into total collapse by 1922 to 1923. He sees a similar pattern emerging today. Post-COVID inflation has already eroded the dollar's value, while the S&P 500 has surged, reminiscent of Germany's temporary recovery. MacLeod warns that deliberate policies are pushing the dollar lower, which, combined with rising bond yields and tariffs, could trigger a sharp collapse in its purchasing power. He notes that, just as certain German industrialists profited from a weaker mark, today's political and economic forces may exacerbate the situation. Once the momentum of a collapsing currency takes hold, he argues, no politician will have the authority or tools to halt it. The scale of potential dollar devaluation, he emphasizes, could be historically extreme, echoing the hyperinflation seen in 1920s Germany. Let's get back to the interview.
Yeah, we're not quite there yet. You mentioning the, Adam Ferguson's book, When Money Dies, and all the rest of it, actually hits the nail on the head. Because I put out a note, I think it was a few days ago, which looked very, very carefully at what happened in Germany between 1918, which was the end of the First World War, and 1923. And there were three phases. The first one was between 1918 and 1920, when the purchasing power of the Reichsmark fell about 80%, something like that. So, this was a nasty situation. Now, this is actually quite like what happened following the COVID shutdowns.
Right.
And then we had this inflation, which meant that the purchasing power of the dollar actually fell. Not as much as 80%, admittedly, but it fell quite sharply. And then what happened in Germany from around about February 1920 to December 1921 was suddenly things improved. And the Reichsmark actually went up against the dollar, which, remember, was on a gold standard, and a proper gold standard. You could exchange your dollars for gold at 20.67 to the ounce. So the Reichsmark was strong. Businesses were recovering, if you like, from the shock, the post-war shock. There was a certain amount of tourism going on. I mean, things were really humming. The stock market tripled. Everybody thought, this is absolutely wonderful. We've got over this, etc., etc. But then there was a crash. I think the stock market lost something like 25% in the December of 2021.
1921.
Sorry, 1921. You're right. I keep on.
Easy mistake to make.
I keep on being a century out of this one.
Right.
So please excuse it. It's my advanced age, I think.
Mine too.
Anyway, between 1921, end of 21, in other words, through 22 and 23, what happened was that the purchasing power of the Reichsmark began to collapse. And the collapse was total. Now, so far, we've had the post-COVID thing, which led to inflation, and now, guess what? Perhaps the long bond yield has not really declined. It's still held between 4.5% and 5%, and looks, if it goes through 5%, then we will be bricking it. It really will be very serious. But meanwhile, of course, the S&P went up from something like 4,200. In 1922 to where we are now, which is 6,500. This actually looks very, very much like that period in Germany between 1920 and 1921. So what follows? Well,
right. That's the bad news.
This is where we are. So how is it going to happen? That's the question. Well, I can see a number of things. We just had Stephen Mirren appointed to the FOMC. No, he's not quite there, but it's just a question of signing on the dotted line. He will be in the FOMC. He was the Mar-a-Lago guy who wants the dollar down and reckons that he can get everybody to agree to it. Well, good luck to that. They are going to destroy the dollar.
Yeah.
The foreigners so far and large institutions, for some reason, are asleep at the wheel. They don't understand what's happening. There is a deliberate policy to drive the dollar lower. And if you look at the chart of the trade weighted, it is awful. It's about to fall from where it is, which is about 197.5, down to 90, and I doubt it'll stop there. So what's this mean? This means that the purchasing power of the dollar is declining. Now, on top of that, what do the foreigners do? Well, everybody, including the large institutions, stand back and they don't buy treasury bonds. Certainly with anything mature, in terms of length of maturity, they're not going to touch it. The only thing that will sell is near cash, which is actually what T-bills are. It's almost like cash, printing cash. So that's what's going to happen. Now, you will get a rising level of bond yields just at the moment when the Fed is trying to reduce interest rates. Well, that's going to do. They're going to have to reverse that. Or the dollar tanks. And if the dollar tanks, what does that do to its purchasing power? It begins to collapse. And then, on top of that, we've got tariffs. Now, I know everybody's running around saying, well, tariffs haven't had any effect. But it does take time for this to work through. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs pushing up prices, if you like. And, that's so much like Germany between 1922 and 1923. So the next question is, we all reckoned that the Germans were muppets and stupid and all the rest of it at that time. But actually, if you read the history, you see, well, it was politics. It was politics. And also, there were elements of industry which were quite happy to see a lower mark because it lowered their manufacturing costs. You had the inflation king, Hugo Stinnes. You had, and this is a familiar name even today, Fritz Thyssen, steel magnate, etc. It was wonderful for them. They were making huge money because their costs were based in Reichsmarks, and they were selling it into global markets and getting gold-backed dollars for it. It was brilliant. But once the collapse really starts, it just gets a momentum of its own. And
Right.
I cannot see any politician in America or anywhere else in the world with the authority to deal with this situation. This is a frightening situation. And the moment this bubble pops, and it is a bubble, Craig, the moment this bubble pops, we will be going into that phase which they had in Germany between 1922 and 1923. And for those who don't know, or don't have a sense of inflation history on this one, before the war, 1914, when the Reichsmark was on a gold standard, the gold mark, in other words, was worth 23 US cents. At the death in November 1923, there were over 4 trillion marks to the dollar. That was the scale of it.
The dollar has been steadily losing its purchasing power, showing patterns reminiscent of historical currency collapses such as Weimar Germany. Excessive credit expansion, rising tariffs, and political mismanagement have created an environment where the Fed has limited control, and extreme economic pressures could trigger unpredictable political and social consequences. Attempts to restore stability through conventional measures are unlikely to succeed, as entrenched political interests and widespread misunderstanding of money and credit hinder meaningful action. While a return to a gold standard combined with fiscal restraint could theoretically provide a solution, prove gold reserves and implement such a plan is politically and practically improbable. In this context, the erosion of the dollar's value seems increasingly inevitable, leaving gold as the only reliable and enduring store of true money. Why is gold considered the only reliable hedge against the dollar's declining purchasing power? Stay tuned. If you're interested in real, data-backed insights on the financial system, be sure to like and subscribe so you never miss our weekly updates. Thank you for your support, and we hope you enjoy the video.